So before we really get into this last chapter of information, let's just review real quick where we've been for the trimester, even though on an abbreviated basis. So we've really done 3 different units. We talked about managing money as our first unit, and there was a lot in that one. We did the pay and benefits, we did budgeting, we did checking and banking accounts, and savings accounts. So that all just related to kind of managing money day to day. Then we talked about the second unit, which was managing credit, and we talked about all the different types of credit there were, what the cost of credit are, and learned how to calculate interest, simple and compounded. And we looked at records and laws related to credit, especially as it related to credit cards. Then the third unit we just finished up was the unit about providing financial security. And we talked about, at a really high level, investing in stocks and bonds and real estate and mutual funds and ETFs and CDs and all sorts of different things. So that was our financial security one. And we're going to end up here this last week with risk management. And you've already seen a couple videos, or should have by now, talking about different things related to risk, some terms and types. But what I want to do as it relates to the text is talk more specifically about automobile and umbrella insurance. So let's go ahead and start this chapter 22, section 2 stuff and talk about the types of insurance and then what umbrella insurance is. So you should have already found out things about renter's insurance and health insurance, which are 2 of the biggies that you should care about, but almost all of you are going to have automobile insurance at some point. And there are 3 bullets here, and this first one is talking about insurance covering the cost of damage to your own vehicle and all the people in the vehicle. So this is if it's your own. The second one is talking about insurance covering the cost of the other vehicle involved and its occupants and any damage that's caused by hitting shrubs, hitting trees, hitting fences, or other property damage. And then the third one's talking about, well, it's not my car, it's not the other car, there's other stuff that can happen, theft-related, hail, those kinds of things. So not from an accident happening with fault, but other things going on. So we'll talk about all those things. So the cost associated with insurance is called a premium. So on a car, we pay premiums to the insurance company for the coverage. We have a policy and we pay that premium related to that policy. And it's typically for a 6-month period when we're talking about car insurance or automobile insurance. And the premium is based on all of these different types of factors, and we're going to do a different slide on each of these and talk about it further. But you are going to do page 221 in your workbook, where you'll utilize some of this information we're talking about on how we could reduce our premiums in the workbook based on the type of car we drive, etc. So you might want to get that out. And it's also page 537 to 539 in your textbook that talks about this stuff if you need that. So we're going to talk about how these premiums are determined, but just know that I can get a discount off this premium, so an amount taken off this premium if I cover more than one vehicle with the same insurance company. So like I have 3 vehicles and I insure all of that with the automobile insurance company. And I also have my homeowner's insurance and other types of insurance with them, so I get a discount. You can also get a discount if you took driver's ed, so that's really important. If you have safety features on your vehicle like rear backup cameras, airbags, things like that. Or if you have good grades in high school or college. So typically a B average or better, you can get a discount, so be sure and ask about those things. So let's talk about the type of car as it relates to our premium and what it does. So let me put this up here real quick. So what this is in essence telling you is that it is riskier and you have a higher premium if you get a new car versus a used, if you get an expensive car instead of a cheaper car. The reason being it's costing more to replace or repair new and expensive cars. It's also riskier and a higher premium if it doesn't do well in these crash tests that insurance companies do on various types of cars. And then you also pay a higher premium if it's a car that tends to get stolen the most. So in 2019, the car that was stolen the most in America was the Dodge Charger, but the 3 or 4 years before that, it was the Honda Civic and Honda Accord. So those cars tend to get stolen for parts a lot, so if you drive one of those, you're probably going to pay higher premiums. Then as it relates to driver classification, let me get that all up there. So as it relates to driver classification, what it's telling you is if you are young, you're paying a higher premium. You're a bigger risk. If you are single, you're a bigger risk than someone that's married. So you're paying a higher premium. If you are a man, you are a bigger risk than a woman is. So if you are a young, single man, such as you teenage boys in class, you are probably the highest risk there is to an insurance company, and you're paying the highest premiums. Okay. Driving record. Your driving record will impact your premium. So the more tickets you have, the riskier you are, the more you're going to pay in premium. The number of incidents, the more you have, the more you're going to pay in premiums because you're riskier. So that's what this is trying to explain to you is more tickets, more incidents, more risk, more premiums. Okay? And this one goes on to talk about misdemeanors as well, and fines and things that you might have. So this last major bullet I wanted to make sure, a lot of insurance companies do use point systems. So an infraction might count as 1 point, whereas a misdemeanor, which is more serious, would count as 5. And if you hit 3 points, your premiums are going to rise. So on your next policy period, your next 6 months period, they're going to raise your premium. If you reach 10, they're probably going to cancel you and not even let you have insurance with them anymore because you're having that many problems and that you're that huge of a risk. So then other factors that we want to talk about. So certain geographic locations have higher accident rates. So as you would expect, if you live in the city, higher risk, higher premium. The length of the commute in miles each day. Again, as you would expect, the more miles you drive, the more risk of an accident. The riskier you are, the higher the premiums. Who will be driving the car the most? If it is me, my husband, and my 3 kids, and one of those kids is a high school boy, and that car is going to be driven the most by the boy, that's an issue, and I'm going to have higher risk, higher premiums. If it's going to be the mother, me, that's driving it, I have some of the least risk because I'm married, I'm a female, and I'm old. So it depends on who drives. If you file too many claims, that's bad. It's risky, higher premium. Whether the accidents were your fault. If they're not your fault, not as risky, lower premiums. If it tends to be your fault, riskier, higher premiums. And the other thing that's not up here that was one of the factors was what the primary purpose of driving the car is. If it's for personal use, it's riskier. If it's for work, it tends to not be if I'm only driving to and from work, not other places. So those are the factors. So then let's talk about these 5 basic types of auto insurance. And this stuff is really crucial to you in real life. And make sure you understand these as we go through them. So the first one is liability coverage. So most states require that you carry liability coverage. This is not on your own car, and it is not on the person or occupants of your car. It's to protect the other person that's involved. So it is protecting the other person's car and the people in the other car. Collision coverage. Collision coverage is for your own car when there's an accident or a collision. If it's your fault, it's your own car. It also would cover you if it's the other driver's fault, but they don't have liability insurance to cover your car. So it covers your car in both instances. If it's your fault, it'll cover your own. If it's their fault, but they don't have insurance to cover your car, then yours will still cover it. And there does tend to be deductibles with collision coverage. Comprehensive coverage. Again, there is typically deductibles involved in this. And this is, again, other than a collision or vehicle overturning. So here's a list of some of the types of things that would be covered if you have comprehensive coverage. So fire, theft, tornado, hail, water, vandalism, things like that. So that's comprehensive coverage. Then you have personal injury protection, which is regardless of whose fault it is. That is kind of key here. And it's covering medical, hospital, funeral costs of the insured and their family or their passengers. So that's PIP. And then finally, there's uninsured or underinsured coverage. And what underinsured or uninsured coverage is, it's just like it sounds. It says that it's their fault when something happened, but they can't pay. So it covers me and all my peeps. So they're uninsured or they're underinsured. They're not going to cover the cost of my vehicle and all the people in it, so this would cover it for me. So that's the 5 primary types of coverages. There is other insurance that's out there called no-fault insurance. And no-fault insurance avoids years of litigation trying to determine who's at fault. So it's lesser lawsuits, more money goes to the injured people in a shorter time frame, which lowers the cost of insurance. So they just don't determine who's at fault. They let it go and move on, is the truth. And then there's these assigned risk pools, which I'm not going to talk about. And then finally, this umbrella liability insurance. So this says that it supplements your basic auto and property liability by expanding limits, including additional risk. It protects you from extraordinary losses. So this is if we had a $1 million settlement potentially, and my auto insurance only covers up to a maximum of $250,000. What would happen if I have umbrella liability insurance is that remaining $750,000 would be covered by the umbrella policy, and they would pay it out. If I didn't have an umbrella policy, my auto insurance would max out at $250,000, and I would have to find a way to pay the $750,000 remaining, file bankruptcy or something terrible. So umbrella just is a higher level of coverage, broader level of coverage. So that's it for insurance, automobile, and umbrella policies. You'll need to do page 223 in your workbook as well, and that's all these different coverages we just talked about: liability, collision, comprehensive, PIP, and uninsured.